This is Monday evening, the 7th of March, and we've been watching the S&Ps and the various stock markets have some trouble, which was anticipated and expected. We're trying to get a handle on where they will go from here, what to expect, and in our case, we're going to also talk a little bit about how we're going to handle it and how we're going to trade it. All right, so we've been saying, and it's been so far unfolding according to the path that we expected, that the S&Ps were going to fall, and they would fall hard. And the worst part of the decline has not yet happened. As a matter of fact, it looks as if, and we're again reviewing the 60-year cycle, the 1962 stock market compared to the 2022 stock market. And the 60-year cycle has been repeating with incredible similarity, over 95% accuracy for the last 18 months, and it's still doing so. What would be expected based on that market? And the other analogs were 1939, 83-year cycle that seems to be repeating quite well. And the 1903 market, which is 120, it's 2 times the 59.55-year synodic cycle of Saturn and Jupiter. We've talked about that. And then the 120-year cycle, which is kind of a uniform thing in nature as well. And that's been repeating extremely accurately. So given all these pieces, the overlap of where they agree is probably the most reliable in terms of the probabilities of what will happen next. The 1962 market makes a high on March 15th, which may translate into March 12th or March 11th, because the 12th is a Saturday. And then it starts down in its ferocious decline, trending lower until late June 25th, 26th. And if it does that exact same thing again, that would be an extremely dramatic situation in the present market, but it is not outlandish, it's not out of the question impossible, because all the prior setups and the patterns leading into it have been repeating, and the planetary configurations of all these planets, 5 planets in Capricorn a week ago, 8 planets in Capricorn back in 1962, and 5 planets in Capricorn in 1903. All 3 markets have very bad years, and this was the time, March is the time when the most severe decline begins, and where does it end, and how do we handle it? Well, the overlap is this, that there, in all 3 of these patterns, in 1939, 1901, 1962, there's a high coming within a week. And today the market was down, S&Ps were down, the biggest decline day in a couple of years, actually, so people are nervous. But based upon the short-term picture and cycles that we're watching based upon 30 calendar days, the moon cycle, basically, there's a good chance that we will see another rally, and it would start tomorrow, Tuesday, and continue Wednesday, the 9th, and possibly Thursday. And it also may be that if it goes down on Thursday and Friday, it could still come up again on the 15th or 16th of next week. So it may not be that it starts, after the report on Thursday morning, and that's the trigger, although it might be. So what we're doing is we're going to continue to add on to a short position as it rallies. If it does rally the next few days, it would be an ideal situation, because you get a better price getting in on a short position. If you're in a long position and you want to find a time to kind of turn to cash for a month or 2, this would be the time to do it. It could be, you'd have to, of course, speak with your investment advisors about whether or not that's wise to do given your portfolio and the tax ramifications and such. But in terms of the market itself, you don't want to be in this S&P market unless you're short. And the 1939 market, again, the same thing. It has that little 2-3 day rally, and then it falls really hard. The 1901, it falls really hard. Again, the patterns are almost identical. So given the fact that the 39 market and the 1946 market and the 1901 market all agree that March into early April is where the biggest decline is, and they were down 18%, 19%, 16.5% during this most recent swing, down 25, 30% from their highs, but the highs, of course, were already earlier in January. So we could see 15% plus move down in 1 month, and that would be worthy of attention, and potentially if you're going to go short, it could provide quite a bit of profitability. We're going to be trading options, and if you are trading options, then you have to consider the fact that an acceleration and a speedy move like that will inflate the price of the options, it'll inflate the price of the VIX, it'll inflate the price of the UVXY and any of these multiply leveraged vehicles, and it might even be better to get out of those positions at the end of March, early April, rather than holding on for the rest of the move, because there's a possibility that the rest of the move may not happen exactly as it did in 1962, and instead may occur more like it did in 1946 or 1939. After the low in April, they have about a month or a month and a half where it's conceivable the market won't go any lower, and it might try to rally. It probably will not get up very far, but it would destroy any option positions that you're in unless they had tremendous amount of time premium. And so that's what we're going to do. We're going to add on to our shorts this week, and we're going to get out of our shorts early April. And of course, you have to do what you think is right for your own account. And I may be wrong, so this is not an absolute truth. It doesn't have to happen. But if it does happen, the probabilities are in favor of a continued decline. The environment is obviously set up for it. This war market is extreme, and things could happen during this time period, which are unusual. The impact of the war, based upon the sanctions, the effect in the commodities markets, the grain markets, the food supply, people are not going to have enough food if Russia, which is one of maybe the largest grain supplier in the world, and Ukraine is the 5th largest grain supplier in the world, if they're both out of commission in terms of exports, and the oil market, obviously, if the United States doesn't buy Russian oil, which at the moment they need, the price of oil was at $130 today, and that's, highly unusual. I don't expect it to stay there. I expect after a little bit more of a rally until late March, oil will collapse back to maybe to the $90 level for a while. So it may not continue. But this particular time is the time of excessive volatility and therefore excessive risk for those who are holding long positions, particularly NASDAQ. If you look today at Amazon was down 6% when the S&P was down 3%. They've been moving in tandem in terms of the up and down moves being in sync with each other. But today it was noticeable that Amazon was outperforming, and it could be telling the story of what the S&P wants to do. So that is the general story. The probabilities of a rally this week are pretty high. I'd give it a 70% chance that there still will be 2-3 day rally, at least. Tomorrow is Tuesday. After a big down day like this, the chances of it continuing directly are small, but I wouldn't get out of a short position here either, just in case, because it could fall. All right, that's the overall storyline. It's our update. That's pretty much how we'd handle it. The astrology is still peculiar. There are numerous things that are happening that are not particularly favorable for the markets. And the similarity between this market, 62, 1903, 1901, 1946, and 1939, they're all real. They're all based on astrological configurations, as well as the confirming evidence that the computer is locating them as extremely highly correlated with the last 12, 18 months in our present market. So I would not fight this probability that we're going to see something continuing to go down. And also at the end of March, early April, that might be the time to take some profits if you're short, because the acceleration will expand the profitability, particularly of options. All right. Thanks a lot. We'll talk to you soon.